Developments of the past 3 weeks are anything to go by. This budget has been a difficult balancing act for the finance minister. Against the limited resources on the back of low economic growth, hampered by structural constraints, there are increasing spending pressures. National Treasury expects economic growth to improve from the lower than expected 0.6% growth recorded last year to 1.9% this year. Government says revenue collection has fallen short of expectations in line with economic outcomes. Revised tax revenue estimate for the 2024-25 financial year is 16.7 billion rand less than was expected. With government expenditure at 2.6 trillion rand, the budget deficit is estimated to be 4.6% of GDP. Government has acknowledged that higher taxes will put more pressure on households and inflation. In order to raise more funds after the rejection of the 2 percentage point value-added tax increase, government has announced a lower VAT increase of 0.5 percentage point this financial year and another 0.5 percentage point hike in the next financial year, taking the VAT to 16% in 2026. Finance Minister Enoch Godongwana says this financial year, the gross borrowing requirement is expected to be 3 billion rand higher than earlier forecasted due to the higher budget deficit. Debt servicing costs take away 22 cents of every 1 rand of revenue collected.
Debt service costs will amount to 389.6 billion in the current financial year. This translates to 22 cents of every rand we raise in revenue. It is more than what we spend on health, the police, or basic education.
Economists say this was a delicate balancing act, likely to be welcomed by markets.
It is a good budget because it maintains fiscal consolidation while it does not cut necessary spending, particularly fixed investment, support frontline services. Those are your nurses, your doctors, your police, your teachers. That remains supported within this budget. So markets should should have a positive response to this budget.
To push for faster economic growth and to create jobs, government proposes an additional 47 billion rand in infrastructure development. This includes investment focusing on electricity, rail, water, and transport infrastructure projects.
Government's GDP figures came out looking at growth of close to 2% for this year, although of course that figure does remain at risk the longer it takes for repair to be effected at Transnet and of course infrastructure in South Africa to stimulate a fast economic growth environment.
Treasury assesses risk to the outlook balanced, but it is concerned about global factors like escalating protectionist measures, geopolitical tensions and trade disruptions, which could spike commodity prices and inflation.
Risks from the global economy are very elevated. We are seeing the escalation of the trade war between the US and its key trading partners, and it could get worse, particularly if Europe also starts to impose all these high retaliatory measures against the US. And with Europe and China being our key trading partners, slower growth in those two regions would hurt the South African economy.
Government says it maintains its stance of not providing bailouts to state-owned companies. It says state-owned companies remain distressed due to weak governance, financial pressures, and ongoing operational challenges. The contingent liabilities from this, however, remain a concern. Dura Safakomusi, SABC News, Cape Town.